Hello, speaking Forex. This is Gregory. It's currently 8:30 p.m. Pacific Standard Time, June 20th, 2012, and this is my analysis for the remaining of the week for the 21st and the 22nd. On my screen here, I have a chart of the AUDUSD, and I think I have a pretty good opportunity to get a good price on a sell to the downside. This is a 4-hour chart, and currently we are at a sell zone, and I want to talk about a few things here. As I draw my box here, let's see. I'm going to fill this into gold so you actually see what I'm talking about here. We are at a sell zone because we have a pretty good convergence of different price levels. We have a wave 1 equals wave 2. We have a previous support that turned into resistance. And also for our Fibonacci to the downside, let me go down to the daily so you can actually see what I'm talking about in a bigger time frame. We actually have a 70% retracement that lines up perfectly with everything else. So if you guys have been following me for a while, I really tend to focus on convergence because I think it reduces the risk significantly when you're entering your trades. And so right now we definitely have that opportunity. So our retracements at the 70% that lines up perfectly with the support that turned into resistance, and also with the wave 1 that equals wave 2. I think it gives us enough confidence that this market should reverse to the downside, at least for either retracement or full reversal. I'm not sure yet, just depends on what the market does. So another thing I want to bring to your attention is the external retracement of the BC wave that is 224%. And it actually lines up perfectly with a half number at 102.50. So we have a lot of things in that area, and so I'm not going to go into every single aspect of every single signal, but we do have enough things lining up in our favor, so we can actually start looking to sell to the short side. So, but one thing, what I prefer to do is I want to wait for a second retest of this area before I start going short, is because currently we look like we are in a channel, or we will be into a channel. And if we go down to the 4-hour chart, this support area seems to be respected here, and I think it would be premature for us to sell at this area. So I will wait for a second retest to the upside. Once I get that confirmation, then I'm looking to sell to the downside. My original targets at 38% actually coincides perfectly with the parity level at 100. So if I can get in around 102.40ish, then that would be a more felicitous opportunity as opposed to selling prematurely at this area. So I'd rather trade on my own terms, and I don't want to be in a situation where I'm trading impetuously. Now, the best opportunity is going to happen when wave 1 and wave 2 is actually going to be in perfect sync, and currently is only off by 5%. That's not a really big deal breaker, but if we can get wave 2 to equal wave 1, that is just another signal to the downside, because wave 1 is around 420 pips, wave 2 is only 400 pips, but 400 pips is still good enough because it's around 5%. There's a 5% discrepancy there, but the 5% is not large enough for us to be of any huge concern. But if it gets up to 420 pips, it's going to line up perfectly with the 102.48 area, 102.50, which is just going to add another area of confluence there, and we can pretty much sell to the downside. I wouldn't even mind selling on a touch and scaling in if I have to, as the market probably falsely breaks to the upside, and start making these targets to the downside. Now, if I miss this trade and the market happens to break the support area, then what I'll do is I'll be looking to sell as support turns into resistance, and I'll still target my parity level at 100. And it's a smaller trade, but I really focus on managing my risk first, and I'm not looking at the pie in the sky trying to capture this whole move and then putting myself when I'm trading impetuously, as opposed to trading according to my terms and my parameters. So so focus on managing risk. Profits come second, and you want to put yourself in a position to where you're not really exposing yourself too much, because if you miss one trade, there's always another trade around the corner. You have so many different pairs of trade and so many opportunities, it doesn't really make sense to go after chasing trades that can be less than optimal. So that's my analysis of the Aussie USD, and I'll be giving updates throughout the week. And if I happen to get filled in on this trade, I'll definitely bring that to your attention. So let's talk about the British pound here. I remember yesterday it was around this time I was talking about selling at 57.35. Eventually we got to that point. I got filled at 57.35 around 11:30 my time, and then the market came down just as anticipated. I was hoping to get taken out at around 56.40 because remember the pivot area was 56.34. And I just wanted to account for the spread and everything, so I actually had my my take profit area at 56.40. But something interesting happened. Now remember, I don't know if you guys follow fundamentals, but I was anticipating a major move to the downside, and I was up around this time, and I was actually looking for a bigger move. Now what happened was that since prior to the news announcement, because this news announcement is at 1:30, I was already profitable in my trade, so I immediately brought it to break even because I wanted to protect myself just in case something happened to where I was not able to get out of the trade, and the volatility, I just wanted to make sure that I was able to control my risk. And so I was already up 30 pips, so I brought my stop to a little bit above break even. And so as the news released, as the economic data was released, the market came down really fast. And so as the pivot area was taken out, I was actually confident that I was going to hit my target. So as the M2 area was taken out, I brought my stop above the pivot area. And so basically this is a mechanical way for me to trade news because it's so volatile and everything happens so fast. It's really hard to define optimal entry and exit points as the market is moving 50, 60, and 70 pips within a matter of a minute or two. And so as this M2 was taken out, I brought my stop above the pivot area, and I was waiting for the half number at 56.50 to be taken out so I could bring my stop above the 56.65 area. And I was hoping that the market just would have came down a little bit further, tested the S1 area, then I would have been taking out the trade with my limit, but that was not fortunate. I thought I had this trade in the bag, and I walked away from the computer literally for like a minute, and the market reversed and took out my stop around this pivot area, which was right above the 5700, and I was only able to squeeze out about 30 pips. That's what happens when you're trading mechanically, and there's nothing you can do about it. Some people may have been try to be safer and actually target the M2 area, from one M area to the next M area. That's a viable strategy as well. But it happens, and it's just what happens. And these are the parameters that I had set before the trade, and I definitely stuck by those rules. But at other times this works really well, and sometimes it doesn't, but I was still able to profit from the trade, and I did not give a cent back to the market after my stop was taken out. So 30 pips is nothing to be upset about, because if you can trade 30 pips a day, you can actually become a millionaire in a couple of years. So the market reversed and it got very volatile. I did not trade this. I was actually done for the day. Quickly, I want to talk about gold. I remember my initial analysis that the market was going to come down around this area. If you go down to the daily, as you can see, this target was eventually hit, and I would not be surprised if my second target around 1582 would be hit as well. But unfortunately, because of volatility, I was not able to hang on to this trade. The market was so volatile that I was actually stopped out with a small profit earlier in the week, and as you can see, the market eventually came down. And came down 400 pips and some change, and earlier this morning it reversed 300 pips and it came back down. This is just too volatile for me, and I was not able to get into on this trade. So I'm already up 200 pips for the week, and I'm not upset at all. But if everything would have worked out in our favor with the gold and without the volatility, we would have been able to at least triple that, I guess, overall return for the week. But 200 pips is definitely nothing to be upset about. So that's my analysis. Now we'll be updating you guys on the Aussie and anything else that comes across on the table, and I try to talk about new concepts on every video, so that way you can actually get the best educational experience as possible. So thanks for tuning in, guys. This is Gregory, and I will be following up later this week on any additional trades that I see that's worth discussing for your benefit. So take care, guys, and until next time, happy trades.